session for the first 30 minutes, but we are flexible. We can extend it if there are too many questions. We can make it longer. But what I would also like to do is to use the second half of the Q&A today, the remaining 20 or 30 minutes, and to start discussing or rather going through the solutions of the seminar 4 questions, so that we have a little bit more time to devote to these questions. And then we will then carry on with these questions for our seminars after this Q&A hour. So the first, hopefully, maybe within the first, 20 or 30 minutes of today's second half of Q&A, we will be able to cover 1 or 2 questions from seminar 4, and the rest of these questions from seminar 4 calculations we will look at during the seminar hours live that are coming later. So I'm going to open the floor to you right now. I don't have any matters arising to report to you. So the floor is yours. Just feel free to either unmute your microphones and ask any questions you might have, or just send your questions by chat. Okay, so I don't have any revision to do today because we are already quite close to the end of the course, and probably you all are now working very hard on your projects and as well as preparing for your in-course exam, so you would have questions, I presume. Okay, the first question came through. Thank you. So I'll read out the question. Our group faces some difficulties when we try to calculate the company's cost of debt. All right, okay, thanks very much for asking this question here in the forum. I've seen that one of your group members have actually posted this question on Moodle, on forum, and I was actually going to suggest to discuss this question during the Q&A rather than posting replies to Moodle. So thank you very much for raising this question. So let's just consider the situation. So one group has done, I assume, has done a really good job of tracing the structure of the company's long-term debt or the interest-paying liabilities, and they have realized that there are around 30 outstanding bonds. So basically various versions or tranches of bonds, and although these different bonds have different maturity dates, but none are publicly traded. So how do you estimate the cost of debt for this kind of company? So unfortunately, because, as you say in your question, these bonds are not traded in the market, you cannot quickly or easily access information on their current yields. Yeah. So what we could do about it is to go by the average debt rating of the overall company. Yeah. So the assumption, of course, it means we are going to make an assumption where the assumption is there that these different types of bonds somehow are averaged out, and whatever the company's debt rating is, or the company's overall debt rating is, it would be representative of this weighted average sort of rating for these 30 or so outstanding bond issues. Now, then the next question is to find out what your company's debt rating is. The easiest way around it is to go to Thomson 1, and rather than going into the research sort of tab where you would normally go to access the sell-side reports for your firm. Instead of that tab, you go to company overview. Let me just actually try and see if I can do it whilst we speak, assuming that the database would actually work right now, because very often it doesn't, especially when I'm trying to demonstrate it. Yeah, okay, yeah, Chuck, hey, right? Yes, so you're saying you found their credit rating. That's fine, that's great. But anyway, for the benefit of the whole class, I just still want to maybe suggest a way of finding the credit rating overall. Let me just try to go to Thompson 1 and see if I could get in. If I could get in, I could probably, hopefully show it. I'm just trying to log in as we speak. Okay, let me just share my screen. Share screen. So I'm here on Thompson 1. So I'm going to go to company view, overview, and company overview, and then I'm going to select the company I want to look at. Oh, that's embarrassing. Again, this is crashed on me. Sorry. And try again. Yes, okay. Right, so I went to this company view, and I had previously already here in this tab, I've selected my company. I selected, just as a sake of example, GlaxoSmithKline. Right, so here what we have, if you scroll down this original sort of catch-all screen of your company, in this section here, long-term issuer credit rating, the one that I've just highlighted. So this section, as you can see, Thompson 1 already provides the ratings by different agencies. In this particular case, for GlaxoSmithKline, it's by Fitch and Moody's. The ratings over the corporate credit. So it's A2 or A minus, okay? So essentially, this is how you can approach the task at the outset to find out the credit rating for your company's for your company overall, which means it's debt credit rating overall. So once you have this figure, once you have the rating, let's say A2 or A minus or whatever, double A or triple B, whatever is that rating, what you need to do, let me just, you could search basically in the internet, Google the current yield. What is the current yield of, let's say, a triple A rated bond or triple A rated debt instrument? And hopefully you will be able to find some from some financial websites where that information is freely available. Incidentally, I was just looking at something similar a few minutes ago. And for instance, I found this website. I'm just going to drag it over here. I found this website here. So I actually don't know what this site is, how sort of reliable it is, but what I found is what are the current yields or the implied interest rates on corporate bonds, which are rated, let's say, Baa by Moody's, and here what you can see on the right-hand side, other yields for other rated bonds. So you could basically use an average approach. So if your company is rated as triple B, I mean, here is the number here, if you can see it. Yeah. So if your company is rated as triple A, which means it's top rated its reliability or low credit risk. AAA is just 2%, triple B is 2.5%, so the spread isn't really great either. So you could actually, these are all clickable, you could click on and check on those things. So I can post this web page to you, but with a caveat that I don't really know what this page is. I mean, who runs this website, but it seems to me they are pulling plenty of data. Or you could actually try your own Google search and find out what the current yield is on a typical, I don't know, triple A rated or double A rated or double B rated or whatever corporate bond. Okay, I'm going just to send this website to you guys in the chat. So I'm going to post it in chat, this link. Oh, sorry, posted in the wrong place. Yeah. So that's how you would go about identifying the cost of debt. So basically, you will identify the overall credit rating of the company, and then you will try to find out what the current yield is for a corporate bond that has the same credit rating, and you will use that. And you will use that as a proxy for the cost of debt in the case of your company. So in other words, you don't really need to work out the real average of these 30 different outstanding bonds, because what you're likely to end up, if you do it very, very, very sort of precisely, just a tiny bit of a difference on a few basis points, at the magnitude of a few basis points in the interest rate. Okay, so I would just do it sort of using a broad brush approach. Right. So I hope that answers this question, but please let me know if it's something is still unclear. Next question is, are words in the table in the group work included in the word counts? Yes, if you put text in the table, let's say you do strength, opportunities, weaknesses, threats, sort of 2x2 table or like boxes, and you write text in each of those 4 boxes, even though you formatted it to look like a table, but in fact it's a table containing text, sentences or phrases in it. So those will count. Only tables with numeric data will not count. Okay, so that's how we that's what should count or not. Okay, next question. We found that the company we analyzed did not disclose 2020 annual report. Could we forecast cash flows in 20 as well as 21 to calculate the price target in 21 by DCF model? Right. I think we've discussed that question, and I think I already posted answer to similar question on Moodle forum. So essentially, if your company, and most of you would be, I guess, in this situation, because in the UK, companies usually their financial year end is December, not all, but most, and so they close their books at the end of December, and then in about 3 months from that date, they publish their annual report. So by the time you are preparing and submitting your report, it's unlikely that you will have actually the annual reports disclosed or published by the companies. Having said that, please check for results announcements. So these are not published annual reports, but early announcements by the management about their results for the year that has just ended. So these are not audited data or reports, so to speak, but these are data that capture the whole year. So it is likely that even though your company hasn't yet reported its annual report, it has already disclosed the necessary information for year 2020 through their results announcement. So for that, you need to go to the company's investment relations web page, find the investment relations or investors web page of your company, and see what was the most recent results announcement or earnings announcements that the company's management have made. So if they have been made, then essentially you shall use these sets of numbers, right, as if they are the full year audited numbers. It doesn't really matter whether they are audited or not for your project. But if none is available, if neither the annual reports are available nor results have been announced in any way, then what you need to do is, firstly, you need to forecast year 2020 numbers. Yeah. And then you need to forecast year 2021, and I presume year 2022. Basically, you would need to forecast. You need to start forecasting rather than from year 21. Now, in terms of the price target calculation, remember, what is price target? Price target is the value, intrinsic value, or the estimated value of your stock 1 year from the date of your analysis. So if the date of your analysis is today, or more broadly speaking, is March 2021, we are in March 2021, then your price target should be for around the March 2022. Okay. So it means that you will need to generate forecasts for 22 or most likely beyond 22, so that you are discounting, let's say, the future dividends or future cash flows or future residual earnings back to year 2022, and that would be your price target. Or you're computing the intrinsic value as of right now, 2021, March 2021, and then from that number, you work out the price target for 2022. And remember that price target equals today's intrinsic value times 1 plus R. R is the cost of equity capital, right? Assuming that the company doesn't pay dividends in that year. If it pays, then you need to factor in dividends as well. So for that, for the relationship between today's value and the price target, you need to refer to the material that we covered in Unit 2 when we talked about, I think it's slide number 14 or 15 there, when we talked about the price targets. Okay, so I hope I answered that question. So essentially, you need to forecast the financial statements or value drivers that you are using in your valuation models, starting from year 20, and then you need to estimate the value, today's value, which is year 21 intrinsic value. And also you need to estimate the price target, which is 12 months from today, and that is 2022. Okay. Next question. When we make forecast of free cash flow to the firm or free cash flow to equity, how to balance the business facts and subjective judgments? Because in annual report, there is not enough specific number to reflect the actual performance of the future. How to make the subjective judgment more reasonable? This is a good question, and this is a question that I'm afraid I cannot answer because it is by definition a subjective judgment. It is your judgment. What you shall try to do is, rather than making assumptions just from the thin air, let's say you pick a number of, I don't know, 7% growth in let's say investing cash flow, in capital expenditures, in capex, right? So where does this number come from? I mean, I presume that a number like that would, or at least you could glean some useful hints from the company's annual report, because managers will be usually talking about their investment programs, their capital investment programs, right? So you would need to try and justify that prediction of the growth rate in, so let's say, capital expenditures from that. Or if you are not going down to that level of detail, you're just overall forecasting, let's say, the company's sales. Again, you need to look at the history of sales, you need to look at the competitive environment and the market dynamics, and also how overall the economy is doing, and make a judgment call, right? Make an assumption as to what is going to be the most likely scenario for your company, hence what is going to be the most likely rate of growth. So you don't just assume, therefore, a number and say nothing about it. You need to, whatever you're assuming, you need to provide some rationale. And I appreciate that this is going to be potentially a very subjective judgment and very subjective rationale, but that's what in real world analysts are doing it every day. And the good analysts are those who can provide more arguments to support a particular prediction or a particular forecast for a number, than just saying, okay, I think it's going to be X. So you should try to say, I think it's going to be X because of A, B, C. So unfortunately, I cannot really tell you more specifically how you make your subjective judgments more reasonable, as you put it. You make them more reasonable by trying to explain them, and explain them by using some sort of logical, by providing some logical relationships behind these numbers. But those would be subjective, okay? Those would be subjective. So, and I know that those would be subjective, so you will not be penalized for that, provided that you try to explain where it comes from, where is your thinking coming from. Right. Moving on to the next question. Could you please give some guidance on credit risk analysis? I'm not sure what you mean by guidance on credit risk analysis. I mean, you could apply one of the credit risk analysis models, let's say the Z-score. I believe you've covered, I believe Dr. Trunk has covered with you the Z-score, as well as the Olson's probability of bankruptcy model. So you could just apply one of these two to see how likely or unlikely it is that your company might end up in a distress. But remember, with a caveat that all of these models, they are just models which they don't necessarily, which may not necessarily work well for your given company. Very often you end up with a Z-score. When you calculate the Z-score of your company, you might end up with a Z-score in one of the upper or lower bands, which would suggest that your company is either non-risk company or a bankruptcy candidate. And if you go back in years for the same company, it could always be showing as a bankruptcy high-risk company, but in fact, the company is absolutely fine. So you don't need to rely too much on these metrics because, as I said, they're just metrics. They're not ideal, and they are developed for a generic case. So they work differently for different industries. So in some industries, they are more accurate. In some industries, they're completely inaccurate. And also, a lot of that depends on the quality of the accounting information that goes into these models, adjusted accounting numbers, unadjusted accounting numbers. I mean, not suggesting that you get involved in any of that sort of debate, but if you want to include an indicator of credit risk in your report in the accounting and financial analysis section, feel free to compute, let's say, the Z-score, or let's say one of the, not one of the, but the Olson's prediction probability, and you could comment on it, but it's again, it's up to you how you read, how much you read into it. Okay, moving on to the next question. We use DCF model to estimate the results of about 120 pounds per share, but the current share price is about 55. We have checked every detail, but still do not know what is wrong. Could you give us some suggestions? Right, guys, if your estimate, intrinsic estimate, came at 120 pounds, then it's it. That's it. That's your estimate. It doesn't mean that you have done something wrong. It means that these, based on your assumptions, based on your modeling, that's the value that you're getting. Who told us, or who told you that 55 that you right now are observing for that price is actually fundamentally supported? Maybe 55 is massively underpriced, right? So that's exactly the reason. That's exactly the reason why we're doing this report, to find out whether the current price of your stock is in fact in agreement or close to the intrinsic value that you would estimate for that stock. So if it's close or if it's the same, fine. If it's massively different, fine. That means that's your analysis. That's what you have found. And based on your finding of 120 pounds per share, and by comparing it to 55 pounds per share of the current price, your recommendation should be what? I presume it should be buy. Just run and buy the stock, because fundamentally it's much more valuable than it's currently priced at. Right? So I wouldn't worry about this big difference. So I wouldn't, again, I want to stress, I wouldn't worry, and please do not try to massage your numbers to make them as close to the current price as possible. No, because that's exactly what we shouldn't be doing. You should be analyzing raw data for your company, its accounts. You should be doing your assumptions, your forecasting, and whatever number you come up with on the basis of analysis, that number should stand. That should be your basis of recommendation. And if that number is 3 times higher or 3 times smaller than the current price, so be it. That's fine. Okay? That's exactly what we're trying to do. Maybe the market is wrong. Maybe the market is depressed for that stock. Maybe the market is incorporating too much negativity into its current evaluation, into the price. Or maybe indeed, maybe you have done some very optimistic forecasting. So I don't know, but just based on the difference of these two numbers, I would not go on and assume that you have done something incorrectly. Okay. Next question. Is it necessary to apply Porter 5 factors in section company background and business analysis? No, it is not necessary. It's a suggestion. In the business analysis section, what you need to do, you need to highlight those aspects of the company's business, its strategy, its competitive environment that you think are important for the investor to know about. And also these factors are important for your assumptions about the future of the company, about its future performance, its future prospects. That section on business analysis is not very long. I can't remember the word size. Is it about 600 words or something? So you can't say a lot within 600 words. Therefore, you have to prioritize what it is that you're going to focus on. You can't say everything about the company's business, about its mode, economic mode, or economic strength, or its competitive advantage or disadvantage, right? You need to prioritize. So what is it that is the most important, some of the most important aspects of its current business model, of its value creation, of its prospects, of its position in the market? So what are the most important things, the top level things that we should consider going forward and for the future sort of analysis of the company and prediction. So you need to prioritize that information. Again, imagine that you're writing this report not for it just to be marked and for you to get a grade, but you're writing that report to a client, to a buy-side analyst, or to a fund manager. So you want your message to highlight the most important aspects about the company's business and performance and the value creation in the model. Okay. Next, moving on to the next question. When we use free cash flow to the firm, we are confused about calculating the working capital. Can we easily use current assets minus current debt, only excluding the cash and cash equivalent? Well, yes, you definitely need to exclude the current assets. Sorry, can we easily use current assets minus current debt? You need to carefully look at the definition of the working capital investment in the textbook for free cash flow to the firm model. So your working capital investment is the difference between your working capital at the end of this year, the year just ended, and at the end of the last year. But the way you work out the working capital at the end of each of these 2 years, from the current assets, you need to exclude the cash and cash equivalents and the current, what is it? Sort of the right-hand side, the current liabilities. You need to essentially from there you need to exclude the interest-bearing portion of the long-term debt. Essentially, you need to you could only there have the accounts payable essentially, and maybe 1 or 2 other items. So what you need to do again, you just look at the definition and a couple of examples that the textbook gives about the calculation of the working capital investment. And if you look at the equity asset valuation textbook, particularly the chapter that talks about free cash flow to firm, it provides you a couple of very good examples what it is needs to be included or excluded. All right, okay, so moving to the next question. Right, okay, I'm just well, I didn't expect to have that many questions, to be honest with you, so it looks like we're going to use the full hour. Still plenty of questions to go through. So next question, I'm reading it out. I want to ask, how do we explain the forecasting inputs in part 4? Do we need write detailed explanation or just illustrate the principle behind our choice? Again, without visualizing what you mean, it's a bit hard to answer, but I'll try. In the forecasting section, you need to state the forecasts of those numbers that you need to explain what numbers you are forecasting, and you need to show the numbers that you have forecasted. And then you need to provide your justifications or assumptions behind these forecasts, behind the numbers. That probably means you need to illustrate the principles behind your choice using your words, using the words of your question. So I don't think you can write the detailed explanations. Again, why? Because simply that section is only X number of words. What is it again? 600 words? Just correct me if I'm wrong. It could be 700, could be 500, can't remember. But whatever is the word limit, you shouldn't really exceed that word limit for that section. So you are limited with how much you can say. So obviously, You start illustrating what the principles behind, as you've put in your question. But if the space allows you to elaborate, of course you can elaborate and you should elaborate, but don't go over the word limit. So write as much as the word limit allows you to write, to provide as much explanation and justification for the numbers, for the forecasts as possible. Okay, I'm moving on to the next question. In the income statement of company, we chose the tax rate is not a fixed value, but what? Sorry. In the income statement of company, we chose the tax rate is not a fixed value. What is going on? Right, I'm not sure what you mean. Probably you mean that the tax rate changes from year to year. So that's your effective tax rate, and this is the case that yes, that effective tax rate will change from year to year, and that's fine. So you just use the tax rate that is effective in the current year's report. And going forward, if you are going to apply a tax rate for your future sort of forecasted numbers, you could just take the average figure of the past few years tax rate. So look at what the tax rate has been this year, last year, maybe in the year before, and take the average of the three, and you could assume that this would be more or less the tax rate going forward. Next question, when we calculate price multiple, which data we use appropriately? Annual report from the firm website or company overview from Thomson? You should, ideally, you should use data from your company's report and from the peer company's reports. And why is it important to do it that way? Is because if you use data from any other sources, let's say from Thomson One or Bloomberg or Reuters or any other third-party information vendors, you don't really know how they are processing the original data. Because very often what they do, they somehow adjust the raw numbers that they extract from the original annual reports of companies. They make some adjustments to these numbers, and then they calculate their ratios or their metrics. And quite often, they don't actually explain how they have adjusted the numbers. You don't really know. So for consistency and for your own certainty of that you work with numbers that you know where they came from, it would be advisable, highly advisable, that you use the numbers that you yourself can locate in the company's annual reports, right? So as in that example, I think for seminar 3 we had an example with the price multiples. The very first example with the price multiples in the seminar 3 is about Tesco, Morrison's, Sainsbury's. We use them as peers to value Iceland. In that table, all the numbers were extracted from these companies' original annual reports. And because this was done by hand, you have confidence in the numbers, and you know that they are on the same basis, or if they are not on the same basis, at least you know that these numbers have a original source. Whilst if you use any other website, a third-party website, you don't really know how they have manipulated these numbers and these multiples. Okay. Moving on to the next question. Are we expected to use only 2 models, or can we use more than 2 if we want? Yes, you are expected to use at least 2 models. At least, it means 2 or more. Okay, next question. A question regarding the in-course exam. Are we required to use Excel and show the ways of computations with it? This is entirely up to you what you use and how you use, but you are you are required to show the workings. Why? Is because if you simply calculate something on the back of a paper and then just upload to Moodle only the answer, let's say the answer is X, how would I know that you've calculated it correctly? What if that answer is wrong? If the answer is wrong, will you get 0 mark for that answer? But probably that answer is wrong because you made a typo, in which case you will not get a 0, you will get still a very high grade because everything else was calculated correctly. It simply was a typo somewhere in your calculations that affected the answer. So for that reason, you definitely need to show the solutions. Now, whether you write these solutions by hand on a piece of paper and then just take a snapshot of that paper and upload that image onto the Moodle when you submit your in-course exam paper solution, or you can do everything in Excel if you find it easier and put that Excel solution there on let's say on a Word document or convert it into a PDF file and upload that solution onto Moodle. Whichever way you go, it's up to you. The important thing is that you show your solutions, you show the workings, so that we can check the numbers, that we can check that the calculations are correct. Okay. Next question. The company we will value has disclosed 2020 annual report, but its peer companies haven't disclosed 2020 annual reports. Can we use current stock price and 2019 annual report to compute the fundamental value using the method of comparables? Yes, you can. What is important here is that you should use data as of the same date. So if your peer companies haven't yet disclosed their 2020 numbers, either in the annual reports or in terms of their results announcements, as I've explained earlier, and if the most recent data you have is from 19, then you should use 19 data from 19, both for peers and your company, but the price or enterprise value, whatever is your numerator in the given multiple, is from the current time, is March 2021. So it is just for consistency, you should use the reports from the same year, both for your company and peers. So the answer to your question is yes. Okay, moving on to the next question. For the forecast of the free cash flow to the firm or free cash flow to equity, there are many specific items in each part of free cash flow, equity and firm. For example, sales, net profit, working capital, fixed capital, net debt. Do we need to predict each of the items based on the business facts to research the final free cash flow to firm or equity? Or we could use some model in the textbook which is based on some simple assumptions? This is a long question, sorry. One of the mode of forecasting these cash flows in the textbook assumes an upward trend of incremental sales, and the model combine the incremental sales with, okay, guys, this is a long question. Yes, the answer is it's entirely up to you. It's entirely up to you how you go about forecasting. You could try individual line, forecasting individual components, and then calculate the overall free cash flow, or any other approach that you have seen as an example in one of the textbooks. So it's entirely up to you. What is important is that you explain the logic and rationale and any of the assumptions, okay? But what it is that you forecast and how you forecast, that should be your choice. So yes, the short answer is yes, you can use any approach that has been shown in any of the textbooks for this course. Next, could you explain the difference between turnover, profit, and revenue in financial statements? Well, usually turnover and revenue is more or less the same. Also, it is the sales figure. So different companies might refer to it So, but you could just assume that this is the same thing. So the turnover, the revenues, and sales is more or less the same figure. Profit, the profit is actually the bottom line. Yeah? Profit is something that is left after you take out all the costs and expenses and various other bits and pieces, gains and taxes and interest payments from the sales figures, basically in your income statement. So if you look at your income statement, the top line, the bigger figure on top would be your sales or revenues or turnover, whatever. And then you would start eliminating various costs items, cost elements, then taxes, and all the way at the bottom you will end up with your net income, and that would be your profit or loss for the year. Okay, so the profit is the bottom bit, and the sales or revenue or turnover is your top line. Okay, next question. Another question is that if we got different number of price multiples method and free cash flow method, does it mean we are wrong and need to adjust our calculations? No. That's exactly the reason why you are asked to use at least 2 different valuation models, because you will definitely end up with different value estimates depending on which model you use. And this is a very normal outcome. So if you use 3 models, you will have 3 potentially very different value estimates. Even if you use just the price multiples, if you remember again in that example for seminar 3, when we had the price multiples for Iceland, valuing Iceland, depending on which price multiple we used, we could end up with massively different value estimates, right? So it doesn't mean that you have done anything wrong. No, what it means is that different models give you different answers. And that's what you have to grapple with. And that's what any analyst has to grapple with. So how do you go about it? If you have reasons to believe that one model potentially is more accurate because, for example, you had to make much less or much fewer assumptions, or you have more confidence in some of the data inputs in one model than another, then potentially when it comes to your final investment recommendation, you could either give more weight to the model that you trust more, or you could even ignore completely the valuation from the other model where you don't have much trust in terms of the numbers of its result. But again, this is your judgment, and you need to just be clear in your report and say what is your final valuation from. Very often what you will see in the real sales side reports written by professionals, they end up exactly with the same situation. They would use 2 or 3 different models. All of these models will give them different results, and they might be just equally weighting these different results. Let's say the price earnings based valuation gave them intrinsic value of $10 per share. The free cash flow to firm based valuation gave them results of $20 per share for the stock, right? And then if they believe that both these approaches potentially are right, then they could just calculate the average of these 2 value estimates. So average of 10 and 20 is 15. And that would be their intrinsic valuation. Or if the analyst believes that the DCF is more reliable, more robust, for whatever reason, they could weight it like 70% weight attached to the discounted cash flow valuation, and the remaining 30% weight they will attach to the multiples based, let's say price earnings based valuation. So the final result will be just 0.3 times price multiple based valuation plus 0.7 times free cash flow to equity based valuation. So that's how the analyst would go about in real world as well. So your situation would be normal if you end up with different multiple or different free cash flow valuations results, and then you need to figure out what you do with this and how to go about it. That's absolutely normal. Again, that's part of the exercise. Next question, if we, wow, that's a lot of questions. If we should not include references to academic articles, how can we explain the basis of selection of evaluation models? You do not include references to academic articles. You explain them based on the company's fundamentals. You explain them based on what you believe is better capturing the company's value creation or fits better given your company's sector or sector structure. For instance, if your company's dividends, if your company doesn't pay dividends, right, then by definition, you cannot use dividend discount model. Or if your company does pay dividends, but the dividends are not, they do not follow a constant percentage of their earnings, of the company's earnings. In other words, the dividend payout ratio is not at all related to earnings, which means your dividends are not related to the underlying value creation, which means potentially the dividend discount model is not very relevant to your company because dividends do not really proxy the underlying value creation. And we know that the underlying value creation is best proxied by the earnings of the company, right? So again, that's your judgment, but that's a justified judgment whether a particular model is more suitable or less suitable. And also, you could rely slightly on your knowledge of what sort of evaluation models tend to be used by analysts for your sector. And for that, you need to look at the slides for the Unit 5, where we have a couple of graphs there showing the analysts' preferred valuation models in terms of the types of valuation models, but then there is also one slide that shows which sort of valuation models tend to be used more often for which kind of sectors, right? So have a look at that slide, that PowerPoint slide for Unit 5. But yes, you don't have to refer to any academic papers here. Next question. Guys, we need to draw it to a conclusion now because, yeah, we only have a minute or two left before we start the seminar. When we calculated the terminal value, we found the big difference between estimate by constant growth rate method and by comparable based approach, such as EV/EBITDA. The estimate is twice as much as another. Yeah, it's normal. It's normal. Again, this is, look, what might be driving that difference? I don't know. Look at the growth rate that you have factored into your terminal value. Is that growth rate realistic? I don't know. Or look at the forecast of the EBITDA for that particular terminal value year. Is that forecast of EBITDA realistic? So look at these figures again. But it is still possible that you will end up with that big difference. And again, it is normal. It is normal to end up with big differences. Just try to maintain consistency. So let's say you have your EBITDA for year T, for terminal year T, and then you have, let's say, I don't know what other model was your model, let's say the dividend discount model, free cash flow model. And your free cash flow to the firm model, your free cash flow to the firm in year T. Is EBITDA and free cash flow to the firm, how do they relate to each other? Look at the development, historic development of these two figures, starting from, let's say, past few years and going into the future up until year T, and see whether these two numbers are actually departing from each other, from one another based on your assumptions. If they are, then probably you need to recalibrate them, because in the long term, EBITDA and free cash flows should be correlated, should be quite closely correlated in the long term, right? Not short. But all other things being okay, sort of done properly, it is plausible that you will still end up with a big difference depending on which approach you use for terminal value calculation. Guys, I fear I will not be able to go through the rest of the questions, even though there are quite a few, because we're now over time. And we have plenty of questions to cover during the seminar. So I need to stop it here. And those of you who are attending the first group of the seminar, please join the first group. So I'm going to end this meeting right now, so we can continue with the seminar at 2 o'clock. And the other group will join at 3 o'clock. Or actually, hang on, just before you log out, guys. I'm thinking how to do it more efficiently. Those who are here, guys, maybe.
Yeah.
Maybe we could just stay on and use the next 2 hours all together, so we can go through your questions as well as all the seminar questions. But in this setting of the entire class, 170 or 80 people. Sorry guys, can you mute your microphones, please? Some of your can you? That would be the best, I reckon. Okay, guys, can you tell me here in the chat if you agree what I suggest? In other words, we don't go to the separate seminar rooms, but rather we continue with the questions right now, and then we continue with the seminar questions again in this big class, and we will have actually more time for the seminar questions and everything. Okay, I see that many of you are saying agree. That's great. That's great. Okay, let's just do that, because that way I will be able to answer all of your Q&A questions, as well as we can cover all of the seminar questions. Okay, that's great, guys. But the problem is, I think 7 people have already left when I said we are going to leave, so we need to try and bring these people somehow back. So guys, listen to me now carefully. This is what we are going to do. This is what's going to be our plan. Because some of you have already left, and I don't want people to be disadvantaged, what I'm going to do, I'm going to try and switch over to my other Zoom meeting and try to bring those people in here. But that means that I might need to end this session for right now, and we need to join this session again in about a couple of minutes. Do you understand what I'm saying? So I'm going to end this meeting that you all are in right now, and you need to log back again into this very same meeting using the same Zoom link in about 2 or 3 minutes, right? And in that time, I will go to the other meeting and bring those people into this one. Okay, guys? So I hope you understand what I'm trying to say. So I'm leaving this meeting, and you're leaving this meeting just for 2 minutes. You will come back and join it again in a couple of minutes, whilst I will bring the other people in. Okay. Good. So I'm ending this meeting now, and I'm seeing you in 2 minutes or so in the same Zoom meeting.